All right, welcome back, everyone. Today, we are lucky enough to have a very special guest on. You don't have to listen to me drone on about personal finance. We've got Evan Kaufman from WeVetHomeLoans. Evan is also a fellow Air Force Academy graduate in 2013, also a fellow economics major. So we get along well. If you want to learn a little bit more about Evan personally, I did have him on back in episode 16, back in October of 2023, if you want to go listen to that one. But wanted to bring on Evan today to talk specifically about VA loan refinancing and kind of what's going on in the mortgage market right now, because rates have been dropping substantially and he's been able to specialize in the VA loans and really get people locked in at a lower rate. Welcome to the show, Evan. Happy to have you.
Hey, thanks for having me back, Eric. Excited to talk.
All right, let's dig in. Evan, what is going on right now? Why are you so busy? Rates are still higher than they were, back in 2019. What's kind of happened in the last few months that's made you guys be really busy with refinancing these people into new VA loans?
Yeah, excellent question. So the past couple of years, as a lot of folks are aware, since 2022, we saw rates go up significantly. All of a sudden, we're working with folks right now who had VA loan interest rates, for example, in the 7s and even 8% interest rate range. And so rates got up real high a couple of years ago, ramped up quickly. And then over the past 12, 24 months, they've stayed up there. They've kind of bounced, and we always can't give specifics, but to say rough ranges of things, we've seen rates bounce between 6 and 8% without people paying money to bring down that interest rate. So a lot of folks, it's estimated that over half of all mortgages are over that 6% mark from the past couple of years. It's really stayed up relatively high. Well, with the expectation that the Federal Reserve is going to cut back their interest rates here over the next 6-9 months, rates have started to calm down a little bit. We saw it earlier this year. There's kind of a little pump fake, so to say, where there's a little bit of drop early in the year. And then all of a sudden, oh no, actually, we don't think there's going to be any rate drop. So things shot back up for the past 6 months even. But now it's looking like it's going to be legitimate. Economy showing some softening where things are getting a little bit slower. Unemployment data showing that the unemployment claims and stuff are going up a little bit. GDP is getting a little bit of a toss up. There's been mixed reports now. And what I like to say, it's kind of sometimes a dismal science when we talk mortgage rates, is that when there's bad economic news, that typically means good things for lower interest rates. Because the only real reason for interest rates to come down is that the economy is doing poorly or there's some other random geopolitical shift that's happening in the world. So we're starting to see some of that. So it's expected that we'll see that. We've talked about it for years. Now it's looking like it might be legitimate. So rates have cooled down a bit. Now, while we're super busy, is because ultimately for VA loans, there's a unique mechanism to it. It's called an interest rate reduction refinance loan. And that's where the VA loan, by law, it was built in to have an easy refinance mechanism. And so a lot of those people who bought over 6% of their interest rate on VA loans specifically are now able to pull those rates down. So we're getting super busy with those the past month here. And I only foresee that happening now over the next 3 to 6 months, picking up steam even more so.
And that's the Earl. You call it Uncle Earl, right?
Uncle Earl, you got it. So that's where you can do 2 different types of refinances with a VA loan. The 2 primary deals we always hear about: cash out, which is more your common refinance, taking money out of it if you want to. But the interest rate reduction refinance loan is exactly what it sounds like. The interest rate is reduced and you're doing a refinance in a new loan. And so IRRRL, I like to say, like you just said it, your favorite Uncle Earl. And so we're actually talking now about getting hats made for it because, man, Uncle Earl's done well. We joke, too, that all my boys all have the initials EEK. I'm the 4th generation. My boys now that I got are the 3rd generation. We're joking if we have our 3rd boy, his middle name might be Earl, just because of how many of these things we're doing for it. But that is it. IRRRL, Earl. I say your favorite Uncle Earl because, we're all not fortunate to have rich uncles, but if you got a VA loan, you quasi have a rich uncle and an Earl that can help you reduce money. You got it.
And if I'm refinancing, let's just say any loan, obviously the Earl is specific to a VA loan. What is fundamentally different about the Earl that makes it so much better? Do we get to forego some of those closing costs? Like, what makes the Earl better than a typical refinancing?
Good question. So the one thing that gets me just excited about, of course, our business is about 90% VA loans, 70% active duty. That's our niche. So one thing that we love, we have what we like to call our client 20-year vision. We'd love to see our clients have a paid for, we say paid for, near paid for home by retirement. If you don't like the thought of having your house paid off, fine. Think financial independence. The only way to get there is to either is to help make sure that you can either pay debt off or increase your investing in savings. Beauty of these refinances is that you can do that relatively easy and cost effectively to increase your monthly cash flow, to pay down debt, or to increase those investments. And typically when you're doing a refinance, like if you had a conventional loan, you'd have to have an appraisal, redo all your income documentation, go through the process of risking maybe being underwater, not on your home, and having it done or not done. And there's just generally more costs to it. For a VA IRRRL, our favorite Uncle Earl here, there's no appraisal, no income documentation. And for credit, we only need now a soft pull on it. So it doesn't even ding or have an issue with your credit. And as long as you've made your payments, then you're not going to have any issue there. So it's really simple, and we can get them done in less than 2 weeks. So we're working one right now. We're trying to knock out in exactly 7 business days, which is the fastest you can legally do a mortgage, VA loan in general, as it is. So it can be done really quickly. Documents are very minimal. We only need a mortgage statement and a photo ID to get the thing rocking and rolling and done for folks.
Wow.
So that's a cool aspect of it. For costs, you don't have appraisal. For lender charges like that we have, it's generally very minimal. As I always say, if you hear, oh, we have no charges, you got to wonder, well, okay, how are you getting paid? So I always say, hey, our basics are typically about $555 on underwriting, $295 on funding. If the rate is low enough, we can always, if you take a little higher rate, roll that in. Point is, it's a pretty minimal cost, right? Less than $1,000. You do have title and sometimes tax charges from the state on those. Mm-hmm. So it depends somewhat on the state. Some states are a lot better for IRRRLs than others. Your Colorado, your Tennessee, your Virginia, your Carolinas, California even, right? That's like the irony. Sometimes folks are like, really? It's actually good for them? Yeah, it usually is. Those are really low cost states to do the IRRRLs. Some states, though, will charge you again, like it's a whole new transaction for taxes and all. So it could be a little bit higher. But most states as a whole, it's pretty cost effective. I always like to say, if you're thinking costs in total to do for an IRRRL, you're usually looking at around like 0.5% of the loan balance. But if you got a larger loan balance, it's usually even a lot less than that. So if you're saving 0.5%, a full percent in interest rate, and it's costing you a lot less than that to do it, you're making it up in a year or less usually to make it, to have it.
And is that different if I have a VA loan, let's say with a different lender or even a conventional, and I come to you guys at WeVet and I'm like, hey, Evan, can we do a VA loan? That's going to be more of a new loan, different process, right? Right. So IRRRL is only going to be on an existing VA loan, right?
You got it. IRRRL can only be on an existing VA loan.
Not changing lenders, like I'm not changing my lender.
Nope. So you can change, well, you can do it with someone new. Like right now, most IRRRLs we're doing are folks with different lenders. And the reason why, because usually folks you're always told, hey, lower your rate when it's better. But then you ever ask the question, how am I going to know? Not many people are usually notified, or you're spammed with so much mail of fake, unrealistic offers that people just give up. So we've created a notification system to give you a legitimate estimation of how to do things. And we follow up with our people, right? But we've made it so it works out well. So most of the VA IRRRLs that we do are actually for folks who weren't even our past clients. Our past clients are getting them done right away. They're in our system doing it. But you can always do a VA IRRRL with a different lender. Now, if you had a conventional loan and you want to go VA, the issue there is that technically an IRRRL, to do that interest rate reduction, it has to be on an existing VA loan. Yeah. So if you wanted to go conventional to VA, you'd have to do a VA cash out refinance first. And that means income documentation and all that good stuff. And then you could later do the IRRRL if you wanted to. So there is that extra step that you got to convert if you went conventional. And that's why I say, if you're going to purchase a home and your VA loan option versus your conventional look pretty similar, like, hey, okay, the rates are relatively close, and I think I don't really care one way or the other. And if you're all of a sudden thinking, well, maybe it might be easier just to do conventional, because that's what apparently a lot of people I say assume. The VA IRRRL is what I would argue should give the winning hand to the VA loan. Because let's say down the road, you lose your job and all of a sudden the economy blows up and rates drop with it, right? Fed cuts rates, which don't directly change mortgage rates, but indirectly they do. And rates come down, but you just lost your job. And all of a sudden you can lower your interest rate. But here's the thing, if you have a conventional loan, you got to do income, you got to do appraisal, you got to go through everything. If you had the IRRRL, no income documentation, you lose your job and still potentially get that IRRRL completed for you, which is huge. As long as you didn't miss your payments and stuff or have a big ding on for your credit, you're good to go. And some people are like, well, Evan, I don't know if that's realistic. All right, 2008-9, it was real. Anyone that transitions out of the military, it's real. We deal with a whole lot of folks, and you and I have talked on it, obviously, with the transition out of the military. Hey, when you're getting out, trying to qualify for a loan, if you're going self-employed, small business, doing your own thing, complete different calculation. Well, if you took out a VA loan before you got out of the military and you decided to, let's say, be like you, right? You're knocking out of the park. Thing is, you're knocking out of the park. You're doing great. But as you and I have talked about it, if you're going self-employed, you need to have a history of income.
Yeah.
So if you wanted to go do a refinance, a conventional refinance right now, Eric, the killer is you couldn't do it if you just got out and you're self-employed.
Right.
You don't have the income. VA IRRRL, you're good. It's kind of like an Armageddon button on a mortgage.
Yeah.
If things blow up, and all of a sudden rates drop dramatically, even if you're underwater on your home, you have issues with your job, you can still go ahead and do the VA IRRRL. No other loan type, it's that easy. So that's a cool feature of the VA loan. And
it comes down to fundamentally, like, why are VA rates lower and why we can do the IRRRL? And it's because the VA is guaranteeing the loan. Totally. That's the end of period, end of story. That's why you guys are able to do stuff like this, which is
you hit it on the head.
So as these rates do come down, talk about how to think about a refinance. Like if I've got a 7.5, or let's just say VA loan rates are today, when we're recording, let's just say they're 5.75, and I've got a 6.5, right? Like, is that worth it? 0.75%? Like at what point do we say, hey, let's do that IRRRL. Let's do this thing.
Good question. So there's two things we look at, and actually the VA requires us to make sure it's happening. It's kind of a cool feature too. Other refinances, sometimes you can get hazy with, is my rate really going down or not? And what's the cost? People start putting finance charges on there called points, et cetera.
Yep.
The VA did a really cool thing when they made the requirements for IRRRLs. Two parts. Number one, as a lender, we got to bring down your rate by at least 0.5%. And they did that for a reason, because usually 0.5% or greater starts making sense. Now, I'd argue 0.5%, it kind of depends where you're at. Larger loan balances, 0.5% can really start making sense. Smaller loan balances, not always, because there's some of those fixed costs. Like if the title fixed cost to do your refinance is $1,000 on a $1 million loan versus a $100,000 loan, well, that 0.5% savings makes less of an impact on the smaller loan balance, right? But on the bigger, it's less of an issue. But that's why the VA requires 0.5% or greater. The other thing they have that they require is that you recoup your costs in at least 36 months. That means that you can't just get charged out to wazoo by a lender in order to go get that. And we have to meet those requirements. Like you'll sign a little sheet at close that shows estimated recoup period, all that kind of stuff, to help make sure that makes sense. Because they essentially say, hey, if you're not recouping your costs within 3 years, it's not worth it. Here's the reality though. We want to see that number usually well under 20 for most folks. And that's usually where we see it, somewhere in that low single digit or mid single digit to 20-ish number. That's usually where we kind of things. And then it just comes down to, hey, do you plan on having the home for at least 2 years or longer or not? So from the interest rate perspective, 0.5% or greater is where the VA wants to see it. I personally would say, hey, starts to really make sense when you get closer to 0.75 and 1 full percentage point.
Yeah, one's a no-brainer.
Yeah, at 1% beyond, it's usually a no-brainer, no matter where your loan balance even is at that point. Well, I'd say maybe 100,000 up essentially. But that whole deal there is 1% above really starts making sense. And one of the analogies we kind of give for that is essentially think of it as like you're rock climbing. And when you're rock climbing, you got a safety line and you want to reset that every little bit. So interest rates, while we're progressing and rates are getting better, people are like, oh no, Evan, should I do it now or should I wait? I'm like, hey, here's the beauty of it. If the savings really look good right now and make sense, cool thing about a VA IRRRL, you can do it again in the future. You reset your time clock. They require 210 days to make sure until you can do the next one again, 210 days from your first payment, but you can do it again in the future. So think of it as like rock climbing, where if you went up halfway, you might reset your safety just in case you fall, you at least got some of the gains. You didn't just go whack the ground. Same thing with mortgages. Hey, as those rates are coming down or improving, getting better, let's take some of those gains, restake the rate. And then if things get better, awesome. We can always do it again. As I say, hey, we'll look at it in a couple seasons here and see if it's good to go again. But if it doesn't, which has happened for a lot of folks before, you're going to be happy that you reset that darn safety.
And it all comes down to duration of ownership, right? Like duration of mortgage balance, right? It's like, hey, if we plan on, depending on the balance, if we're like, hey, we're going to pay this thing off very quickly, well, that changes things. Or we're going to sell or move really quickly, well, that changes things. But if we're going to have this longer than that period, for sure, nobody knows anything for sure, then it makes it much more of a no-brainer. Like, because what we're doing basically is we're comparing, right, that closing cost. Obviously, if your rate's going down, we're saving on that monthly payment, but it's that closing cost that we do need to recoup. So how do people think about also when it comes to that closing cost, let's just say, making up a number, let's say it's $3,000. Are people paying those usually in cash, or are they rolling them into the loan? How do people think about that?
Good question. So you're really, VA loan, again, being unique versus any other refinance option you really have, they allow you either option. You can pay for those, the costs effectively of doing the loan. You can pay for it at that new closing if you want, but they'll also allow you to roll it into the loan if you want it. So that means that effectively, if you want, you can accept a slightly higher loan balance and have nothing due at close. So what we try to do is give folks two options. I like to say, hey, we give you the two extremes. We give you what we call the cash due and the cash back option at close. VA loan will allow you to get back up to $500 if you wanted it at close. But that means that loan balance is going up a little bit. And we're always very open to say, hey, you just got to make sure you're aware that is going up a bit. So how long are you really planning on holding this home? If you're going to sell it within the next couple of years, doing usually the cash back option might not quite be worth it, because even if you're saving a decent amount still, if the recoup's really good, then maybe you still could do that option. But normally, if you're selling it real quickly, you might want to do that option. You might want to stick with okay, hey, I'll just bring a little bit to close and make sure my loan balance stays the same. But you really have those two options or anywhere in between. We see most people still trend towards, hey, Evan, I'm going to own this for another 3, 4, 5+ years. Then they go with the option of essentially taking the costs and rolling into the loan. Now, the other unique thing is that some folks out there will say, oh, hey, you don't have to make payments for 2 months or a month or two. Okay, you don't miss payments. You more like skip payments than miss them. But it is true that when you do a VA IRRRL, while it's a streamlined refinance, it's also still technically a new loan. So if you close on it towards the end of the month or the start of a month, then you have the option of missing your next payment or skipping your next payment. And then since this is a new loan, if you didn't know on other loans on purchases, you don't make your first payment until the second month. It's not that the payment just disappeared. You make a prorated payment at closing, but you don't make that next payment until still a follow-on month later. So for example, right now we're shooting this end of July. We've got a bunch of these VA IRRRLs closing here at the very start of August. And what that means is they're not having to make their payment in August. They're also not having to make a payment on September, and their new loan will start technically October. So you're getting to skip those payments. Although by no means does that mean they just disappear again. So that effectively, as I like to tell folks, you can roll those essentially into the loan if you want, or you can bring those to closing, not see your loan balance change, and on we go. So usually the biggest discussion I'm having with folks is, hey, do you want that loan balance? Do you want to bring the future payments and costs to close, or do you want to try to roll that into the loan? Somewhere in between. That's usually the biggest debate for people.
Yeah, that totally makes sense. And I think from a planning perspective, I talked about this with you offline yesterday, but if I'm thinking about let's just up the balance a little bit, make it more substantial. If I got to bring an extra $10K to close, or I can just roll it into my 5.75% loan and keep my $10K in my high yield savings account paying 5.1. Well, yeah. I mean, that's not a bad deal, right? I'm not losing out on much there if rates are this high in savings accounts. So it's something else to think about, I think, for folks as they're thinking about mortgage rates and where they are and comparatively to, the opportunity cost elsewhere, whether that's in markets or high yield savings accounts. But I've just thought about that personally when I'm thinking about how much to put down and all that. It's like, hey, if I'm being only charged 6% or something like that on a loan, but I can get a 5.1 risk-free, well, that's not too bad just to have the liquidity, right?
No, you're spot on. When you brought that up, you're right that today we're seeing that because risk-free rates are higher than they've been for the last many years, right? So that reality is there. And if ever anyone's like, but there's always got to be a catch to these. Sometimes I just had was that yesterday, 2 days ago, conversation of, well, Evan, I'm just still not getting there's got to be a catch to this. And I'm like, when you're saving, this dude was saving over 1% on the loan. I'm like, there really isn't. I'm like, hey, clearly you can see the cost here for it. This guy was actually active duty still. So I will say active duty still has a small VA funding fee too. It's 0.5%
Oh, interesting.
So know
Okay.
that active duty still has that part too. So that gets added on as well. But it's minimal. It's 0.5%. If you got VA disability comp, it's waived and gone.
Zero
So
for disabled veteran. Zero.
Yep,
Right.
you got it.
Okay.
2% or greater, it's waived out. So the deal here though is we're looking at it that the closing costs totaled up to like $3,000 or $4,000. But he's like, how does this? It's really there's still got to be a catch here for it. And I'm like, hey man, you're saving over a full percentage point on your interest rate. So just think of it this way: if you have $500,000 loan balance, you're saving $5,000 a year in interest. You're saving a full percentage point in interest on a $500,000 balance. That's why it truly is the equivalent of close to a free lunch. Like as long as you don't sell your home in that period, that's why we do that recoup calculation for you. As long as you don't sell that within that period, you truly are coming out well ahead when you do these refinances. So, and it's because you're charged less interest. And one other thing we try to help show people with that is we give them the scenario on our sheets that we make. We show you the monthly savings, but then we also show you the interest difference that savings could make over the lifetime of the loan. So assuming you effectively kept your payment the same, did the refinance and just poured that savings into the paying off the new debt, that gives you a rough idea of, hey, what could be the overall value of this over the period? And it will chop off, one, a lot of time on the loan, but number two, save you a lot in interest. For your sake, I actually made me a nice example of the common ones we've been doing. We actually did that classic $500,000 loan balance. It was actually a little bit less than that, $497. But ultimately, it's like, hey, we're pointing out how you're saving a few $100,000 over the life of the loan. If you took, in this scenario, it was like $400 or $500 a month, $450 something, and you apply that just towards the payment, you're going to save hundreds of thousands off the interest. Plus, you're going to shave off, God, what was that one? Like 100 payments worth or whatever. So 8 years or so off the loan. Pretty wild. And we break all that out for folks on initial sheets. I'd say that's one of the good scenarios, but not the best. And then some people choose to do it when it's a little bit less, right? They're happy to do it when they're shaving off 2-3 years of their mortgage. But I'd say most are shaving off quite a few years.
Wow. Yeah, I love that. I love that how you guys display that. It's showing people that interest over the life of the loan. Like our brains really can't compute compound interest at all. Like they're not, our brains think linearly, right? Like they don't really understand that like, oh, a 1% interest rate reduction is going to save me hundreds of thousands of dollars in interest. Like it's crazy when you see that played out. And the planner and investor in me, wants to take that even a step further. I know you guys can't really display this on your sheets, but like, okay, let's go invest that in your Roth 401k and your Roth IRA. And what is that over 30, 40 years?
For sure.
We're talking
big
money.
It'd be a lot more. And usually we'll mention, that's the one we'll mention. Hey, if you're talking with your advisor, if you're saving, say our average right now, I think for all these ones, it was like 300 some bucks a month, roughly across the board from loans for around $1 million to down to a couple $100,000. But if you're saving $300-$400 a month, if you took that and went and invested it, you could make a lot more. But here's where I can show you a true return. Like it's literally guaranteed return, 5.75, whatever your interest rate is on the loan, that's guaranteed. But if you go invest it and you make more, that number's a lot larger. And that's very real. Again, it kind of comes back to that, how is this really that good? I'm like, well, it's because you're charged a lot less interest. And over time, it makes a huge difference. Now, one other option you can do with these two, and some people are like, well, Evan, I did it, and I actually didn't pay anything for it, no cost or anything. I'm like, well, that is possible. And that comes back to where I touched on earlier. If you want to sometimes accept a slightly higher interest rate, so rather than you shaving off a full percentage point of your rate, maybe we only shave off 0.75 or 0.5%. And when we do that, if you're accepting a little higher interest rate, we as a lender can get what's called a credit, because technically how our mortgage is done, think about it, they're debt instruments. So I guess this is more of a finance podcast, so people might kind of get it. When you're creating mortgages, you're effectively creating bonds. So a higher interest rate bond is worth a little bit more, essentially. So if you accept a slightly higher rate on that refinance, we can sometimes get a credit to cover all those costs. But you're still getting a higher interest rate than what you would have before. However, you're still coming down whatever that is, 0.5%. So you're truly saving a full whatever percentage point is off your old rate. So it's still a no-brainer. The unique thing with these IRRRLs, though, It's just that since you can roll those costs into the loan, you can take the lower interest rate if you wanted and just put the extra little bit of cost into the loan, and you'll technically save more. How that one works out is just you'll save more per month and not have as much cash due up front.
We'll put this in the show notes for sure because people need to go to this calculator. You guys just rolled this thing out like last week. Talk about this calculator, what it does for folks and kind of what it shows folks.
We call it the VA Loan Rapid Refi tool. So nothing else out there quite like it that we ever seen. I think the reason why is because there's so many different loan types. If you tried to make this calculator for just mortgages in general, it would just implode because there's so many variables that have to go in. But since we are very niche, we're very focused, VA loans are our thing, active duty is our main focus. It allows us to build some unique tools and services. And this is that one. So it won't work for conventional loans, won't work for FHA or USDA or any other types. We're staying specific on VA loans. But if you go to it, it's actually the only calculator we've seen out there that one, it'll tell you instantly if you qualify, or I should say not qualify, but you're eligible to do a VA refinance. So number one, it tells you if you're eligible to do a VA refinance now. Number two, if you're eligible to do a VA streamlined refinance, it'll give you a rough estimated savings based on just a couple basic data points. We don't ask for a lot of private information, just a couple basic data points for you, and we can give you an instant estimate of what you're looking at. And then number three, if you're not eligible, it's the only system we've seen that'll actually notify you of when you do become eligible. And that's the cool thing about it. Because we've gone around and talked with so many real estate agents, other lenders, home buyers who have bought the last 2 years above that 6% mark, for example, or even high fives in rates. And we're like, hey, everyone has said, lower your rate in the future. Buy now, don't worry, you can always refinance later. Or they've heard the term date the rate, marry the home or whatever. It means you can always change out your rate later. And I've just asked the question, cool, man. Well, like Johnny, Sally, the agent, how do your clients plan on doing that? And then the agents are like, well, I don't know. Maybe I was a lender. Ask the lenders. I'm in the lender world, mortgage world. I get pitched products all the time. There ain't no product that gives automatic notifications for stuff. And I'm like, well, that's not there. And then I ask home buyers, how do you think you're going to know when to do that? And they're like, well, someone's going to tell me, right? I'm like, there's just nothing there. So the cool thing about this tool, it is that chance to have an automatic notification. We're not spamming people with a million things either. The goal right now, we have it so that when you become eligible, you get a notification via email. We'll reach out just to make sure you're aware of it too. But the goal then is to be able to have it at a quarterly or semi-annual basis to where you get a nice little update if you're eligible or not and what that could look like for you. But the key is the notifications for people just to be aware. Because otherwise, what we're seeing right now, there's folks that we could have done a VA IRRRL for months ago, and they've already could have been saving a couple $1,000 over the last few months, but no one told them. No one got in front of them.
Yeah.
There's the two major things we see. Number one, no one followed up with them from the past. I would say it's your old lender, old systems or servicers that just didn't follow up. Or number two, they got pummeled with so much spam mail, because some people will get hit with that via like letters and stuff saying fake offers on VA refinances, that then when they call in, they get terrible service or they find out the offer is completely bogus, because you mentioned points earlier, extreme crazy finance charges, and then they give up. Our goal is to have a legitimate system that notifies you, gives a very reasonable, real estimation of what you can do, and then to follow up with it, because that's all we do.
Yeah, that's amazing. The monitoring and proactive reach out is just something I haven't seen. I mean, it's something I try to do with the tool for some of my clients just in general on their debt, but I don't have like anything. I've never seen anything that's VA loan specific for this. The proactive telling them, I mean, people just intuitively think like, hey, the lender's trying to make money. Like they're not the bad guy, but I'm the customer. Like it doesn't compete with most people's brains that like, oh, like there's a lender out here that would actually be like reaching out to me to save me money. Like, it's like, what? Wow. That doesn't, it's not supposed to work like that. Like but that's what you guys do. I mean, cause this is active duty and veterans, like VA loans, this is your niche. You own it.
It's
amazing.
It's our niche. It really all comes back to it. I think we're very unique in that we have what we like to call our client 20-year vision. We want to be with folks for their whole 20-year career if they're staying in. And of course, we work with a lot of vets too. That 20-year vision of making it so you have a paid for, near paid for home by retirement is something that really does drive us. And if you notice, there's part of that really itches out my personality. If you know me personally and knew me especially before mortgage, you know, wait, Evan doesn't really like debt. I'm like, yeah, I don't. And that's ironic that we're doing mortgages. But I saw so many people, especially our clients that we were working with, as we worked with military clients as a real estate brokerage so much, they just get spun up in very high interest rate VA loans, weird things all over the place. And when I learned the math and how to operate and build the mortgage business behind it, I was like, we got to go do this, not because we love debt. It's because we can help people reduce debt. And that's the weird anti thought process we have. And a reason why I love VA refinances, VA streamline refinances, is they're a true win across the board. And it comes back to that concept of where if you're going to have that financial independence by retirement, say that near paid for home or that nice big retirement stash that Eric's helped invest for you, the only way you're getting there is if you make more money or somewhere you increase your cash flow. And the cool thing about these are they help reduce that debt load and increase that cash flow so you can go achieve that. Sure, will some people go buy the Teslas or whatever else? Yes, but you're never going to hear me recommend that. I will always recommend pay down the mortgage or go invest it with your advisor so you can keep growing from there.
Yeah, I love it. Just as you were talking, I was clicking through this. Like, I'll just talk people through. This will be in the show notes. So if you have a VA loan, you should 100% check this out. But all it asks for is your current interest rate. I said 7%. January of 2022. I set an original purchase price of $350,000 in veteran. Asked for your address, and then the estimated savings was $178,000 of interest, or $340 a month on a refinance right now. So that, and then it asks just for your name and your email and your phone, and then they're going to send you the next steps on that. So, I mean, pretty quick. Took me about 20 seconds there. Just amazing.
20 seconds. And as you point there, you didn't actually have to put in your name or anything to get the estimate, right? So that's the whole goal, is so many folks want to get everything from you. The address portion is to make sure state, so it helps some of our calculator for the back end with things. But the key there is to make sure that, hey, you can get a rough idea without it. Know their estimates. You'll see some of the disclaimers at the bottom and all that good stuff. Pulls in R rates, runs things against it. But it's pretty legitimate estimate for most folks that are coming through on there, or I should say kickoff starting point. And if they fill that information in, we're reaching out within 24 hours. We have that mostly automated, but we want to make sure we get a little more refined information from you. And we're getting you what I sent you before, which is that nice comparison of, hey, here's how this works. Here's your options of what you can do. And then you just give us a yes or a no. It's a 15 to 20 minute discussion. And then you can decide if you want to do it or not. And otherwise, you can elect to be notified in the future if things get better. And on we go.
I would urge, like, I'm not here just to promote Evan. I'm here to like put out good information, but I would urge anybody that has a VA loan or any loan and is a veteran or active duty to reach out to Evan. If you have questions on any of this, go through this calculator. No better guy to talk to about this, and it's not even close in my mind. So, Evan, thank you so much for coming on. Any last words for the folks, how they can find you, website, LinkedIn, all that good stuff? Where can people find you?
Excellent. WeVet.com. That's where you're going to see all the good information out there for us. Evan at WeVet.com is my email address. It's WeVet with 2 T's in there. And then you can also, of course, see all my socials there, LinkedIn, Facebook, etc. But if you reach out to us directly on the website, you're still getting me. I got staff that can help process some things, but you're dealing with me most of the time still on everything. So that's the basics of it, Eric. Appreciate you a whole lot, man. What you're doing for folks is absolutely wonderful, and hope this can just be an extra tool to help people realize some savings, especially as rates start drifting down. I should say, knock on wood, are drifting down and hopefully continue. Granted, the election, by the way, no idea where that's going.
No one knows.
You asked me that. Everyone's like, which way to go? Like, well, historically, they say rates drift down before the election, and they go, it's a coin flip one way or the other. But this election's starting out with the bang. So literally a bang when you think about it. Like, it's going nuts.
Yeah.
So I don't know what it's going to be at the end of that. Another reason why, if you're over that 6 mark, especially right now, maybe reset that safety pin, and then we see which way this thing goes. Because if you did an IRRRL, for example, now, you're eligible to do that again next spring already. So once the election's done and starts settling, we can see which way it goes. At least you locked in some stuff today.
Wow. So what's the gap between IRRRLs?
210 days.
210 days. So is that 7 months? 7 months if I'm doing the math?
Depending on the months, right? So to line up with February or whatever.
Yeah.
But it's 210 days, and technically it's 210 days from your first payment. So it can make it a little bit longer. However, we can always lock in our rate earlier. So that's where I say, hey, we usually are reaching out to folks around that 6 to 8 month mark, roughly, from when they closed. Because if rates are looking really good, we got a few of them right now that they technically don't hit that 210 day mark until the end of next month. but we've already got them in. We can even already get them locked up and ready so they know the savings are coming. We just got to wait a little bit because you can do everything beforehand. You just got to wait till that 210-day mark hits.
I love that. Yeah. Yeah. All right, man. Well, thank you so much for coming on. We will put all these resources into the show notes, but really appreciate it. You're the first recurring guest on this podcast. So this will not be congratulations. This will not be the last time we have you on. That is for sure. I know that first episode we had together, I think is still my most popular episode. So hopefully this one will beat it. Really appreciate you and all your knowledge and everything you bring.
Love to hear it. Appreciate it, Eric. Thank you very much, man.
Thanks, Evan. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the Bluff Finance Podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.